Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Options trading has exploded in the last few years, and recently a particular type of options trading has become popular with retail and institutional traders alike. 0 days to expiration options. It's called 0 DTE for short. These are contracts that expire and become void the same day they're traded. Business is so strong that the ETF industry is now getting in on this. Last week, we saw the launch of the Defiance NASDAQ Enhanced Option Income ETF. The symbol is QQQY. This is the first ETF to trade in 0 day to expiration options. Let's talk with the woman in charge of that ETF. Sylvia Jablonski is CEO of Defiance ETFs. Also joining us, DJ Tierney. He's the Director and Senior Investment Portfolio Strategist at Schwab Asset Management. So Sylvia, the strategy here is fairly simple. You're harvesting a premium, right? You're selling puts on a NASDAQ index. Selling puts is a bullish call, guys. So give us an example. How would this work?
Yeah, and thanks for delineating that. It is a bullish call. It is not a bearish call. So what we do on a daily basis is that we enter into trades where we essentially sell slightly in the money puts on a daily basis. And to your point, they're almost void the same day. So at the close of today, we'll be selling puts that are slightly in the money, and then the trade expires tomorrow or cash settles essentially. So there's no stock assignment, and hopefully if the market has, sort of minimal movement, we capture the full or some portion of premium on a daily basis. And the idea is that you would capture enough premium on a daily basis where you generate outsized returns for investors. So we're looking to hopefully generate 25 basis points per day, shooting for 60% type of income distribution. If we manage to do that, we will be the highest income distribution on the street.
Yeah, that's high. So I just want to make it clear what we're doing here. So remember, you're selling a put. You want the market to go up.
Yes.
So if the market goes up, the put expires worthless. You keep the entire premium.
Exactly.
And you distribute this as a dividend.
Yes.
Right.
So we collect the premium on a daily basis, and we'll distribute the actual income on a monthly basis. So the way that you can kind of see that actual income if you're an investor is to look at your account at the end of the month, and it'll come in.
So what kind of dividend do you think you're going to?
Yeah, annualized.
It depends on the market.
It
depends
on the market, right? So if we back tested it from the time that these were in existence, which was 2022, and we compared them to some of the other strategies out there, the QYLDs, the Jefferies of the world, and we're looking to return 2 to 2.5 times that, because what happens is with those strategies, which are actually a very similar risk profile, that's another point that we can talk about too. It's super interesting, but we've heard a lot about how risky this is. The risk is pretty similar to a covered call strategy, right? But what happens is that every day we get a chance to take a little bite of the apple and generate premium instead of just kind of being locked in for that monthly call.
It is a covered call premium, essentially, but it's a daily.
Yes, exactly,
right.
exactly.
Right. No, so it's easy to see why these options have exploded this year, folks. Think about what this does. This gives active traders more ways to play the market. It's a one-day bet, so you win or lose the same day. It's cash settled, and that's very important. You don't get stock, you get cash. And so you get this dopamine rush if you win on a daily basis. Then you can do it all over again tomorrow. So I guess the problem we have, and here's a little summary about how they work here. The criticism out there, and even Gary Gensler at the SEC has said this, that this encourages market timing and day trading. And we know the vast majority of people are going to lose money doing this. Gensler's written about increasing gamification of trading. You know about these kinds of criticisms. I know you're providing a product to the market, but what do you say to that?
Yeah, exactly. And what's really interesting is that the covered call strategies don't really get that same bad rep, but this is the same thing. It's just sort of.
But it's a daily thing. There is this dopamine little rush of a daily bet.
There is for sure, but what I would say is that strategy has essentially just been turned upside down with the realization that, hey, you can actually generate daily income and perhaps outperform those strategies. But what I'd like to say about this is, and we talked about this before, this is something you can do in a retirement account. Like, we're holding cash, short-term treasuries that return 5%. We're selling in the money puts that are cash settled. So, worst case scenario, you have the risk of Qs, of the NASDAQ, or, JEPY.
Right, there is limited loss. You can only lose what you put in.
Exactly.
Yeah, that's for sure.
And perfect example, Friday, NASDAQ was down 1.7%. We were down about 1.4% because you're
selling the premium.
Yeah, you got a little bit of premium there.
All right, let me bring you in, DJ. You're the wise old man here. This is obviously for active traders.
Right.
How do you advise Schwab investors who want to be active traders and try to time the markets in general, these kinds of strategy? What do you tell people?
Well, we really do skew towards long-term investing, long-term strategic allocation, and I think it's great. The ETF marketplace has been one of innovation and has brought a lot of new strategies and access to a lot of things for investors. But from our perspective, with equities, international equities, bonds, commodities. I mean, traditional asset classes, there's a lot to do. And we really do focus on years, decades of planning and asset allocation. You know, this kind of strategy, you know, could be, you know, a fringe or satellite complement, but a bulk of your assets we would want in longer-term traditional assets.
So what do you tell the people who want to scratch that itch? You know, this is always the inner Jack Bogle in me kind of comes out. Jack used to say, take 10% of your portfolio and go ahead and, you know, try to gamble it away. But he always used to say, you got to find out. You're probably not outperforming anything.
Yeah, no, I mean, the data would suggest when people try to time the market, individual investors, even advisors, when they try to time short-term market moves, generally it works against them. Either transaction costs, taxes, or just getting the calls wrong. So really, one of the Schwab investing principles is ignore the noise and focus on the long-term horizon.
Sylvia, let me just ask, I'm going to go back to the zero date expiration options. We know the derivatives market dwarfs the underlying markets in size. The numbers I see are like crazy, you know, like $1 quadrillion or something, the notional value of derivatives. And we literally don't know how big the derivatives market is. Is there any concern these derivatives eventually get so big that there's some kind of systemic risk, excuse me, that the tail wags the dog, essentially?
Yeah, and people have talked about that for a long time, whether it's through levered inverse ETF products or whether through these, you know, same-day options products. But if you look at, the CBOE actually has a lot of good data on this. If you look at the flow on this, even on the days in June where these zero DTE options had, you know, sort of a huge day, you know, max amount of options contracts sold, there was only a 1% net change in the volume. So, you know, you have buyers and sellers, and historically for all of these derivative products, it tends to balance out. You know, you have market makers out there hedging their exposure, you have clients hedging their exposure, there are buyers and sellers in equal amounts. So we haven't really seen a derivatives product yet that really, you know, skews it one way or the other, where we're sort of nervous about not being able to maintain the exposure or the trade that we're looking to put on.
It's remarkable. I had Ed Tilley on from CBOE. He helped popularize these zero date expiration options. Index options in the first 6 months trading up 43% from the same period last year. Cash equities options down 11%. So individual cash equities down, index option trading, and most of this is, there's the numbers there, most of this is increase is zero dated expiration options. So this is a hit. I mean, Ed's just ecstatic.
It's a trillion, I think they put out the number the other day. I think the average was $1 trillion in assets traded in these short-term options.
Now, this is an ETF that you have. You just introduced this last week. These are options on the NASDAQ index.
Yes.
But you're introducing options on the S&P, right? Tell us about this.
Yes. So tomorrow morning, JEPY will start trading. It's the same concept. We're going to be trading essentially short selling puts that are slightly in the money on the S&P 500 at the close, and the trade will expire within 24 hours. Hopefully we'll collect the premium on a daily basis, and the idea is to give investors, you know, outsized returns, enhanced income with the risk of the S&P 500 versus the NASDAQ. You know, the two most popular arguably traded indices in the world are Qs and SPY. So
now, there's also zero data expiration options on the Russell 2000, right? There's the small cap, right? So there's only three. They're all
only
indexed.
Three. Yes.
So it's NASDAQ, S&P, Russell.
Yes,
but you're not doing one on the Russell.
We have one filed for that.
Oh, you do?
Yes. The next one that will be trading, though, will be JEPY tomorrow.
So, okay,
yeah,
so that one's coming up.